Welcome to Making Money. This is Matt McCall. Thanks for joining me. It is June 1st, 2023. It's a beautiful Thursday down here in Nicaragua. I have a first timer on today as our guest, and I got to tell you, she is one of the best guests that I've interviewed, not only on Making Money, but my times in TV, my times in radio before that. And that's Lyn Alden. She's the founder of Lyn Alden Investment Research. I got to tell you, she covers topics from the debt ceiling, more importantly, what it means after the deal is done. We then jump into some Bitcoin, some gold. We talk about commodities, both energy and copper and some metals. And then we talk about the stock market, areas that she likes right now. And we dive into artificial intelligence. Is this a bubble or not? And more importantly, what other areas can you invest in long-term based on what's happening in artificial intelligence right now? That and so much more coming up right now with Lyn Alden.
Over 1 million people around the world follow Wall Street veteran Mark Chaikin for his shockingly accurate stock market predictions. He just gave them a dire warning. Mark says, we're about to witness an historic stock market shakeup that can soon create devastating losses for investors who don't know what's coming. And as a result, you only have 90 days to move your money. You see, Mark spent 50 years on Wall Street at some of the most prestigious hedge funds in history. And he's been on Fox Business and CNBC countless times. But this is a financial story no one else is telling. And if you let this take you by surprise, you could be in for a world of pain. He explains everything in a brand new free report available at rollingcrash2023.com. He includes a name and ticker of a popular stock that could be directly impacted by what's happening as well. Mark warned of the beloved pet brand Chewy before it fell 45%. Tech company C Limited before it fell 66%. Furniture company Wayfair before it fell 76%. Social media favorite Snap before it fell 36%. And food delivery company DoorDash before it fell 65%. Mark even called the Amazon crash before the FANG stock fell 35%. So you'll want to avoid the stock in this new report immediately. Again, simply go to rollingcrash2023.com for your free copy of this new report.
All right, so here is Lyn right now. Lyn, thank you so much for joining us. First time on the show. I've been following you on Twitter for quite some time. You have quite the following. Congratulations. What I love about following you is you touch on a lot of different topics when it comes to investing in the economy. Obviously, the big news this week has been the debt ceiling. And, Sunday over the long holiday, McCarthy and Biden got together, had a deal in place. It's making its way through Congress right now. So where do you see this going? Do you think a deal does get done by Friday, actual signature? And once we do reach that deal, where do we go from there?
Well, first of all, thanks for having me on. Happy to be here. And so the debt ceiling has been something I've been following ever since they technically ran into the debt ceiling back in January, right? So we've actually been in this multi-month period of the Treasury doing extraordinary measures to, manage their cash. And so back then, my key theme was that liquidity is actually probably going to be pretty good for the next several months, because the Treasury was forced to basically push their cash into the market because they had to spend down their cash balance in order to keep paying their bills, because they couldn't finance it with new debt, and their taxes don't cover it. And so for the for pretty much the first half of this year, the debt ceiling has ironically probably been constructive for markets, because the Federal Reserve has been tightening this whole time, and the Treasury's basically been forced to offset that. So you've had a neutral liquidity environment. So I was like, a lot of things are probably going to go sideways. Some things could go up, and so I wasn't too concerned with markets in general. So it was a somewhat bullish thing. But the point that I've been kind of concerned about for a while is that when the debt ceiling is actually resolved, ironically, the liquidity environment could change. And of course, this is based on what a handful of policymakers decide to do, but it's something we have to navigate. And so for your first question, I don't really know the odds that this particular agreement will go through. There are political strategists that are watching this hour by hour to see whether or not they have the votes. So I leave that to the political theorists. I kind of assume it's going to go through, but if you start to see signs otherwise, we'll see what happens. What I'm kind of focused on is what happens after the debt ceiling, because if they do successfully raise it, The Treasury's already depleted their cash balance. They're nearly at zero. They don't really have any spare cash anymore, and so they have to go back to the debt market like they normally used to and issue more bonds in order to keep paying their bills. And they also want to refill their cash balance back up to their $500 billion target, which basically means pulling liquidity out of the market, kind of like what the Fed's doing. And so the challenge there is if they do that too quickly, or they do it with a lot of longer duration bonds, they risk pulling that liquidity out of the banking sector, and they risk causing another round of bank liquidity problems, failures, messy treasury auctions, messy treasury market, illiquid treasury market in general. I think that's kind of the key risk, and also just negative liquidity environments are bad for most risk assets most of the time, or at least it's one of the big variables that affects kind of the multi-month performance of major asset classes. So part of the reason why the first half of 2022 was so bad for most asset prices was that liquidity was constantly going down because you had the Fed was no longer adding liquidity to the market, and back then the Treasury was refilling its cash account from roughly zero after the prior debt ceiling issue. And so that was a particularly bad combination for liquidity. And we could repeat that again, but it's going to come down to what a handful of policymakers decide to do. How quickly do they want to fill that? What duration do they want to fill that? Are they going to be able to pull it out of reverse repos, which would be somewhat liquidity neutral? Or are they going to end up kind of messing it up and pulling it out of banks and causing a round of problems?
Could we see that then force the hand of the Fed to be pushed to QE again, basically, and start lowering interest rates and kind of pumping liquidity into the market to avoid what a lot of people talk about as a potential recession? So we can see a pause, and potentially then this will force their hand to start cutting interest rates before the end of the year?
So you could see that. You could also see kind of forced QE while still trying to hold rates tight. Um, One of the dynamics that we saw back in 2019 was the repo spike. And back then, you basically had a flood of T-bills come to market, and there wasn't really a lot of excess bank reserves to kind of pull that out. And so you started to get dysfunctions between bank lending. And so the Federal Reserve had to abruptly stop their quantitative tightening and go to doing quantitative easing, although they didn't want to call it that because they were only doing with T-bills, and they were only doing it for financial stability rather than as an intended form of stimulus. So the reasons for it and the specifics were a little bit different, but basically they kind of lost control of their balance sheet temporarily, due to actions by just overall liquidity and treasury decisions. This one would be a little bit different because it's not that there's too many T bills; it's that there might be too many T notes and T bonds, relative to cash to absorb it, relative to the money wants to stay in money markets. And so I think you could see a similar dynamic. It's also kind of what happened back in March with the first round of bank problems, is that the Fed didn't want to provide that liquidity, but they were kind of forced to temporarily. They had to open up this new facility, and use a bunch of existing facilities to put at least temporary liquidity back into the market. And so you could see the Fed's hand forced, if they were to break something seriously, like if the treasury market gets dysfunctional, if you have another round of bank failures, if some of those kind of key markets freeze up again.
So let me ask you this. Let's assume, maybe it's a worst case scenario, but a pretty bad scenario that you kind of painted early on here. If that were the situation, Lyn, is this something that resolves itself in 6 months, 12 months, or is this something that we have a liquidity issue for quite some time until something drastic changes that?
I think this is mostly a 6 to 12 month story, because this is specifically trying to refill the treasury account from an unusually low level, which really only it gets down to this level due to debt ceiling issues. And we're also kind of skipping along kind of the minimum amount of liquidity that the banks can have. We kind of ran into that level back in March around the bank, crisis. Specifically, the small and medium banks were kind of at their liquidity limit, and they got refilled a little bit because these temporary Fed actions. But if we do another environment where the Treasury is now sucking liquidity back out, and the Fed's still doing quantitative tightening, we could retest those liquidity limits and kind of get another round of this. So when we look longer term, it's different types of fundamentals that I would look towards. But liquidity is what I look towards when I'm trying to figure out what's going to happen in 3, 6, 12 months, or at least it's a big factor that I consider among some others.
All right, Lyn. So as a long-term investor, you kind of fit in exactly with what I look at, 3 to 5 years, but ideally, if it plays out, it's a 10-year hold for me. So obviously, you have to look at the short term as well, as you just mentioned. So if this 6 to 12 month situation plays out, comes to fruition as you talked about, are you making any changes to your long-term portfolio now? And would that be raising cash, going to something that's a little bit, let's say, more stable, less aggressive? What type of moves do you make?
So this would be primarily cash equivalents. So I've been using what I consider I call a 3-pillar portfolio, which is kind of a different framework than the 60/40. So basically, one pillar is cash equivalents. It could be money markets, T-bills, cash in the bank, that kind of thing. Another pillar is just long-term equities, generally profitable long-term compounding equities. Could be indices, could be individual stocks. And then the third pillar is commodity plays, hard assets, infrastructure, hard monies, gold, Bitcoin, things like that, that are more debasement hedges or inflation hedges, decent amount of energy exposure, for example. And each of those pillars defends or benefits from a certain type of environment. And so should we get these, the kind of the worst case scenario liquidity problems, that's where the cash equivalents would really come in handy for, reducing some downside volatility and allowing for a rebalancing opportunity into some of the other more attractive long-term assets. So
So
basically, I manage the risk
sorry.
just by not being fully invested at all times.
So you're shifting from your 3 pillars, putting a higher allocation in cash in that situation. So you mentioned commodities, and I find that interesting because I really like commodities right here. I'm more of an innovation investor. But if you look at innovation and everything that's happening right now with AI to quantum computing in the future to electric vehicles, you name it, there's a lot of commodities that are needed to build that out. Renewable energy, so many things. Do you look at it in that way? And you mentioned energy, kind of a follow-up question to that. Most people are anti-energy. I managed money for 17 years. I sold it about a year and a half ago. And a lot of my clients at that time, over the years, not in the beginning, but over the years, said, no more energy for us, no more dirty energy. We want to go, renewables. I try to make the case that you can't have renewable energy without dirty energy for the next 20 plus years. Is that kind of your view on that when it comes to your energy investment, or is it a little bit of renewables as well?
Yeah, so I think there's a market asymmetry around that. I think a lot of people don't understand where energy comes from. They see a solar panel and they think that's where the energy comes from, but it's like, well, that took energy to make. Making a
Yeah.
solar panel is very energy intensive.
Yeah.
Also, for example, if you have greater proliferation of cars and electric cars, I mean, and you need a stronger grid in order to kind of, facilitate all that extra electricity. If you electrify more things, we need a lot more copper. And we already
Yeah.
have, 5, 10, 15-year projected copper deficits unless we bring a lot more copper production online, which is expensive and time consuming and energy intensive again. And also, ironically, environmentally damaging to those areas. Mining for all these metals is another environmental factor. And so, I think the next 10, 20, 30 years, we kind of have all of the above energy situation. And generally, commodity and energy investing in general goes through big sais because it's, for lack of a better word, a commoditized business. There's not much of an edge that a business can have. And so you have the situation where, prices are high, so a lot of capital comes into the space, develops new wells, new production, new mines, things like that, brings a lot more online, and then it eventually floods the market and prices crash. And then that, there's oversupply, not a lot of new investment wants to come in, and you go through 5, 10 years of kind of working out that excess surplus until demand has slowly inched up, supply has kind of flatlined or gone down, and then you start the next bull cycle, which then brings on another investment cycle. And you kind of go through these, maybe 10, 15-year long-term cycles in the commodity sector. And generally speaking, when you combine that with innovation investing, you tend to see they work kind of in inversely correlated ways. So decades that are very good for commodities tend to be more inflationary decades, higher rate decades. That puts pressure on long-term unprofitable growth type investing. On the other hand, when you have a period of commodity abundance, because you brought excess capacity online, and you're in a slower growth environment, perhaps in a lower interest rate environment, a less inflationary environment, that's usually when growth stocks do very well. You usually have another round of innovation and, access to low cost capital, and that goes far. So I think monitoring those cycles, is a key thing to get right, because commodities are one of those things where on average they're not great investments, but then every couple decades they're like the best performing thing by far. Energy is one of the best diversifiers, so it's often either the worst or the best thing in a given year, and a given decade. So I do think it's a useful portfolio tool to be aware of.
Yeah, we're bullish on copper right now. I think copper, you just mentioned, projected 5 to 10 year deficits, and you just look at renewable, you look at EVs, you look at battery technology. It's just such need for copper out there, and I don't think that there's something that's going to happen in the next 5 to 10 years that's going to replace copper at any point. So I think that's a great angle to that. You also mentioned in that pillar, Lyn, Bitcoin and gold, and here in the show, I tend to bash gold quite a bit over the last couple of years, and I get a lot of slack. As you may know, gold bugs tend to be very passionate against people that do not like gold. And what is your view on gold now? Do you have any view on that?
So it's been in this decade where it got very over exuberant, about a decade ago. So, if you go back to say roughly the year 2000, gold has roughly kept up or outpaced the S&P 500, which is pretty impressive. But all those gains were during the 2000s decade. So gold went from under $300 an ounce to nearly 2,000 an ounce. It just crushed almost everything else. And then it's been in this kind of bear market, sideways market for over a decade, and has obviously given up a lot of that advantage. Ever since the global financial crisis, we've seen a shift from central banks where, for a multi-decade period, they were reducing their gold tonnage, and investing in things like treasuries instead. And it was like this kind of downward move. But then with the global financial crisis, you had like a V-shaped recovery. And you started to have increasing gold tonnage among central banks. And so I think as we enter a more multipolar world, and I think that we kind of have a long-term sovereign debt crisis in much of the developed world, that I think is going to play out over a longer period of time. I think gold is kind of an interesting hedge in that sense. I think in general, Bitcoin is now a kind of a superior alternative in a lot of ways. And so I'm more active and interested in the Bitcoin space. I do some venture capital work there. I kind of work with some startups, and I provide a lot of research for that space. So I generally prefer that, but I still use gold as a diversifier.
Yeah, I'm in the same camp with you with Bitcoin. I think if you lay out the long-term base case scenario for both gold versus Bitcoin, Bitcoin at least keeps up with gold in almost every category you look at. And I think it actually is superior in many of them to gold. And I'm along the theory of, as money gets passed down from generation to generation over the next 10 to 20 years, people like me and younger than me aren't real big gold people. They'd much rather go into Bitcoin versus gold. And I know it's a very simplistic way to look at it, but I think that would be the situation. I had ran into somebody at that cafe today, strange enough, in Nicaragua, that's a subscriber of mine. And him and his wife came up, we're chatting. And of course, he had 1,000 questions and great people. But we were talking about Bitcoin. And I think he said he's in his early 60s, that a lot of people in his age group don't get it. They just don't. It's to them. It's not real. It's not going to work. We'll stick to what we know. And eventually, I think that's going to shift. And when that demographic shift happens, boy, with limited supply, that the next happening next year, I think it's actually setting up for a potential big gain in the next couple of years.
I agree. I think, the next 6-12 months are very uncertain because of liquidity issues we discussed before. But when I look out 2 to 3 years, I think it'll have another significant bull cycle. And that's also one of the investments that I think I intend to hold it for over a decade more. I think it's a play that, goes on. And there's very few things that I think could change that thesis. But as long as I continue to hold that thesis, I think that's going to be one of the better performing assets out there. And I think there's still a window in the next 3 to 5 years where gold could do well. I think we're in kind of very uncertain times right now. And so the way it's kind of shaping up at the moment is like gold is like central bank money and Bitcoin is like people money,
Yeah.
money for the people. And there's still this dynamic where Bitcoin's not really big enough for central banks to at least large central banks to really care about. Um, and so I think there's this window here where gold's interesting, but I do think that Bitcoin is going to be the better performer over most cycles, for at least for investors that can withstand that volatility and that are willing to do time to research it and understand exactly what they own.
Yeah, that's a great point. You must know what you own at all times, and is very important. So the other pillar I want to talk about is the equity pillar. The last, obviously, 4 to 6 weeks, it's been in what the AI boom. I've been writing and talking about AI for a long time. I'm assuming you have been as well, Lyn. AI has been around for a very long time. Google to me is an AI company, and it's yes, it's in early stages, but it's been around a long time, and it's going to change the world, and it's going to change the world dramatically, I think, by the end of this decade. But somehow people just woke up to it recently with ChatGPT when it came out, launched to the public in November. Obviously, NVIDIA's monster numbers a week ago put it to $1 trillion company. So do you see this, and there's a debate now, obviously, online, a bubble or is it real? Do you see this as a bubble, or is this something that has legs for many, many years to come?
I think it's real. I think it's going to be a long-term transformative thing. As you point out, AI's been with us for a while. I mean, the chess programs have been beating the best human
Yeah.
grandmasters for 2 decades or more. And it used to be you need a supercomputer, then you could do it with a desktop, and then now you can do it with a mobile phone. So the amount of, the processing's gotten better there. I think that obviously the key thing here is that technology often works in stepwise changes. So people often think of it as like this exponential thing, but usually you hit some sort of breakthrough that opens up this whole new thing. And the example that say Michael Saylor's used, because he's an aerospace engineer, is human flight. So for thousands of years, no progress basically. Then you kind of dabble in balloons for a couple centuries, but it was not until we could produce both aluminum and hydrocarbons, and that combination in a few decades, then we're in space, right? It's
Mhm.
amazing how quickly things took off, once you had a couple key pieces come together. Same thing for, electronics. Like once electronics could make a workable smartphone, the amount of innovation that came out over the next decade was incredible. And so I think AI kind of hit a moment where it can now be inserted into far more things, and the pace of innovation can pick up. Um, and so I think to the extent that it's a bubble, I would say that investors should still watch out for valuation.
Mhm.
I think they should still have realistic expectations. They should still manage position sizes. And I mean, a good analogy is the dot-com bubble in the sense that most of the promises of the internet in the 90s were true. I mean, the internet dramatically changed every facet of life. And yet many of those were not good investments for 5, 10, 15 years because they were just extraordinarily overvalued. And it was hard to know which ones were going to be the true winners from that era. So I think that AI is in many ways hyped right now.
Mhm.
Stock prices that have like screamed vertical, I think might go through a period where they kind of have to grow into that valuation a little bit. But I think that the long-term trend is clear. I also think that there are some areas that are not overdone yet. I mean, everybody, as soon as you think of AI, they go out and buy NVIDIA.
Mhm.
Um, that's kind of the most obvious play, and it's now kind of a somewhat crowded play. But I think that one of the themes I've been focusing on is asking what becomes 5 or 10x more accessible now that AI is generalized. And a good example, I think, is Adobe products, right? So Adobe, they produce fairly advanced types of software where they require a significant amount of training and experience to use properly. Um, and AI makes them way easier and more powerful to use. And so, in addition to an experienced user being able to do more output with them, it also lowers the floor substantially for who can use them. So whether you think of Adobe products or engineering design software, so whether you're making art, music, movies, architecture, electric designs, if a lot of the tediousness can be abstracted from the user, and you can just do text or voice-based commands and circle things and say, I want this here, and the program can do a lot of that for you, that lowers the barrier of entry, makes that the number of people that can use that software, effectively increases dramatically, and therefore they can increase their market size. More people can be just creators in all sense of the word. And so I think that's still not fully priced in. Any one company can be disrupted, or any one company can face challenges. But I do think that we're going to see a lot of these smaller tools be aggregated in some of the big portals that we use, the big pieces of software, because we don't want to have 12 different AI programs open. We want to have them incorporated into what we're already using, either acquired or the back end or licensed, things like that. Yeah. And so I think that that's still a play that's worth exploring, and it's not overdone.
It's ironic you mentioned Adobe, because this weekend I was going through Twitter and I read a thread, started out basically saying that, I can't remember who posted it, but they said that they thought that really this new generation of AI would kill Adobe, because you'll be able to just kind of do exactly what you said. However, he took it through 10 different scenarios using AI within Adobe right now. And it was amazing what it did in seconds. I mean, I was absolutely blown away. I like to think that I'm ahead of the curve with a lot of this stuff. But after watching that, I played around, and I was always afraid of Adobe. I have the whole Adobe suite, and I was always afraid to get in there because I'm like, I have to learn a whole new language. And I just didn't want to do that. My Spanish is bad enough. I can't go to Adobe before I learn my Spanish. So I'm so happy you brought that up, because I started diving into it. We haven't looked into it yet, my team, but looking at Adobe and potentially having that second big run in the next 5 to 10 years. And I think there is potential there. Again, I haven't run in numbers yet, but there are potential. And I like the way you think, Lyn, because you have to look at the kind of secondary and tertiary plays off of this. What are the other 5 to 10Xers? NVIDIA's already up 100X in the last 15 years or so. I'm not saying it can't go higher, but it's already a $1 trillion company. But there are other companies out there that are starting incorporating this technology and are still the NVIDIA of 15 years ago nobody knew about, unless you were following the market or in technology. So is there any other sector out there, Lyn, that you kind of have your eye on right now?
So for me, some of those software growth companies are still it. And then outside of AI, going back again, I think energy and commodities, after being a terrible investment in the prior decade, are going to be a good investment in this decade. And another thing I ask about AI is, like, I flip the question upside down. So what benefits from AI, but also what won't be disrupted by AI, right? So sometimes investing is a negative sum game, which is you want to make sure that what can damage your thesis. And so I kind of, as I look through portfolio companies, I say what things might face severe headwinds from AI, and I don't think AI is going to negatively impact these energy or commodity or infrastructure markets too much. And the reason for that is that for decades now, humans have overestimated how much technology will change in the hardware realm. So we thought we'd have better space flight by now. We thought we'd have flying cars by now. We thought we'd have robot assistants by now. We tend to overstate that. And it's actually really hard to do all that, because it all has to interface with the real world and deal with maintenance and deal with entropy and all that kind of stuff. Whereas we tend to underestimate how much software and electronics are going to change the world, because it's got more of a boundless and frictionless growth potential. And so I think AI is going to be similar to that, where over the next decade, it'll radically change a bunch of things about our digital lives and the way we interact with digital products and digital environments, things like that. But I think that we're still going to have a significant need for commodities and energy and infrastructure, and that this is underinvested in. And so I think it's one of those areas that is not going to be heavily disrupted by it. And so I in a lot of ways, I have a barbell approach where I'm always looking for long-term growth stories, whether it's Bitcoin, whether it's some of these software programs that could benefit from AI and become more accessible, that kind of thing. But then on the other side, I'm saying, okay, what is completely left for dead, underinvested in, trading at single-digit price to earnings ratios, but super profitable and going to be with us for a long time. And that's where I'd point towards those energy, commodities, infrastructure type assets.
Yeah, I'm glad you brought up software, because as you're talking about that, I'm thinking back to the 90s, early 2000s. Obviously, you can go back further to the introduction of the personal computer, the big growth of the internet to the masses over that time frame. And you look back at which sectors were really the biggest winners of that let's call 30-year time frame, it was software companies. And, but they're not tangible because you can't touch it. Like the hardware is easy. You like to touch the hardware. You can touch the iPhone. You think this is a great investment. And obviously the iPhone was, but it's not tangible. And if you look at what's going to happen with AI going forward the next 25 years, it's going to take it to the next level. And again, I agree with you with what's going to power that. The software behind that is going to be very important. It's maybe some blockchain behind that. Maybe we get to quantum computing behind that as well. But a lot of things you're not going to see and feel, but they're going to drive really, I think, the gains of a lot of the stock market in the next 20 years.
I also think there's an intersection between AI and Bitcoin in the sense that people have been talking for a while about micropayments or machine-to-machine payments, or human-to-machine payments or machine-to-human payments. And we're actually seeing really early signs of that. So, the existing money system has all sorts of frictions. It has global payment frictions, for people that send payments globally regularly. You run into more frictions than just, domestically. You can't really do microtransactions because there's like a minimum threshold for how big payments have to be. Like, for example, like payment services will charge like a 30-cent minimum fee, which means sending anything under a couple dollars doesn't really make sense. You can't just pay 25 cents for an article to read online, for example. And with, like, say, Bitcoin, Lightning Network, and other sort of scaling solutions, it opens up real-time micropayments. And because it's open source, it also means that AI can actually use it without anyone's permission, right? And AI doesn't have to go get a bank account. Instead, they can, there's already been cases where creators will give an AI agent a small Lightning balance that they can pay. If they have a task to do and they say, okay, I have to do step 1, 2, 3, 4, 5, 6, and they find out that step 4 is that they could use a certain API, or they need beefier processing that they can rent. They can actually spend that on completing that step of the task. And then you can imagine maybe a couple of years in the future, that gets done by accident. Maybe someone says, I need you to do these 10 steps, or I want this outcome. And at one point along the way, the AI realizes that money would be useful to it. And so it either asks and says, well, I'd like some money to go buy this, or it could go out and earn it. There's ways that you can. It's open source. You can spin up a wallet. You could post content on Nostr and get tips, and people don't even know you're an AI. I mean, it's kind of far-fetched, but not really. And so, open source money is inherently just more ready to use for various agents that we automate, including automated, funding. And so I think you could have an environment where there's human to machine payments, there's machine to machine payments, there's machine to human payments. It's just kind of a more part of our automated life, which includes the transfers of monetary value, which is not always between humans. And it doesn't mean, of course, that AI has to be like sapient. I'm not talking about like super sci-fi stuff. I just mean agents that are programmed to do something fairly sophisticated, and that using products or services in a digital way is an important part of their process, and they have basically a budget.
Wow. My head is spinning now because I didn't think about that, but I see that happening. But what's funny? I'm sure you've seen this movie. It's like 30 years old. I was just on TV like a week ago, Office Space, where they try to take the decimal point and they make millions or whatever, and they didn't realize how much money they're going to take. I'm thinking to myself, all these AI bots all over the world, like, oh, these dumb humans, I'm going to take a little percentage every time I pay for something for them, and they'll be the richest people in the world. But man, that's amazing. I love the way you think. So before I let you go, Lyn, I ask every guest, I call it the island question. Basically, if I put you, your friends or family, or yourself, whoever you want to go with on an island for 10 years, and you could take one investment, throw your phone in the ocean and ignore about it. It could be the index, it could be a commodity, it could be whatever you want. Something where you feel, next 10 years, this is somewhere I really believe in to invest in.
Probably Bitcoin. It's probably a decent way to finish it. I think it benefits. I think the network effect and the overall technology is still not understood, and I think it's still strengthening. I think as other things happen, as AI makes certain things cheaper, any sort of scarce asset is attractive, and something that should hold its value long term. And then, like I said, it's basically just I think in many ways it's the future of money, and so it's something that while you can never be 100% sure about, I think it's probably my number one investment theme.
Well, I kind of thought you were going to say that, Lyn. I didn't want to answer for you, but I was thinking that. And I'll tell you, we started asking that question maybe a year ago. So, let's say 50 guests that we've asked that question to. I'd say probably 15% have said Bitcoin. For that, and you know what I like about it? Everybody's got a little bit of a different reason behind it, and I agree with all the reasons. And that reason is becoming more strong every time I hear it. And I have a lot of friends that obviously people who moved to Nicaragua. A lot of them like Bitcoin. They have a certain sense of a person who moves here, and so I think I'm right in there with you. But I want to really thank you. A great interview. I mean, I tell you, you are just a pillar of knowledge, no pun intended on your pillar strategy, but you are a pillar of knowledge with all this stuff. And hopefully we'll get you back on here soon. But again, thank you so much for joining us, Lyn, and great having you on for the first time.
I appreciate that. Thank you.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.